Supermicro computer and a NASDAQ SMCI closed recently at 3054, up about 0.36% on the day. This modest rise comes after a turbulent week. The stock fell over 11% from its recent highs to that same 30.54 level, after reporting a staggering $12.7 billion Q2 revenue, 123% YOY growth. SMCI's shares have been trapped in a tug-of-war between blowout top-line results and collapsing profit margins. Today's slight uptick tests a critical support zone near $30. A break below high 20s could signal further pain, while a sustained rebound above the mid-30s range might reignite momentum. In other words, investors view this price action as a decisive inflection point. The line between seeing SMCI as an oversold AI catalyst or as a company grappling with deeper structural issues. Current price action analysis. Technically, SMCI's chart is notably volatile. After surging 113.8% on February 4, the stock retraced the next day and then ripped 111.4% on February 6. Such swings, on heavy volume, underscore intense indecision. The shares have been oscillating in roughly a 28 to 34 range. Intraday highs around the mid-30s this week and lows just under $29. Its 52-week low is $27.60. Support appears to lie in the high 20s, while resistance sits near prior swing highs in the low 30s. The current 30.5 price is perilously close to the recent bottom and squarely below the 50-day and 200-day moving averages, reflecting significant short-term weakness. Volatility has spiked. The stock's one-month realized range is but 9%, and roughly 18% of the float is sold short. In short, technical indicators suggest a bearish bias. With high short interest, any bounce could trigger a short covering rally, but a breakdown would likely attract fresh selling. Investor positioning is mixed. Approximately 55% of shares are held by institutions, from mutual funds, pensions, etc., and insiders hold about 14%. Institutional traders have already incurred losses on recent rallies. Performance YTD is just plus 4.3% despite large gains early on, and they remain wary around current levels. Company overview and business model. Founded in 1993 by Charles Liang, Supermicro is a specialized server and storage hardware provider deeply embedded in modern IT infrastructure. It operates as a total IT solutions company, designing GPU-optimized servers, blade servers, storage arrays, and AI accelerators, sold primarily under its Modular Building Block Solutions or ER framework. Customers, originally mid-market enterprise, have shifted to hyperscalers and AI-driven cloud clients. In practice, SMCI maintains large manufacturing centers in Silicon Valley, Taiwan, and the Netherlands, allowing it to vertically integrate and rapidly deploy new chip architectures, e.g., liquid-cooled NVIDIA Blackwell GPU clusters, far quicker than many competitors. This first-mover ethos, pounding out systems for the latest AI chips while optimizing for power and cooling, is central to SMCI's long-term vision. Management emphasizes speed to market and energy efficiency, free air or direct liquid cooling to capture AI deployments, and even touts itself as the indispensable monopoly for NVIDIA and Intel in the data center space. In short, Supermicro makes its money by selling high-density server racks and related products to customers building large data centers or AI factories, relying on razor-thin margins but huge volume. The firm claims to deliver both components, motherboards, chassis, power supplies, and fully integrated systems, effectively an Amazon of hardware vision that can be tailored rapidly for any workload. This building block strategy, allied to a recent focus on U.S. manufacturing, including a new federal market division, positions Supermicro as a leader in cloud, AI/ML, 5G, edge computing, and government sectors. Institutional activity and smart money behavior. Institutional interest in SMCI has turned cautious. Notably, Goldman Sachs recently downgraded SMCI to sell, warning of margin compression and weaker pricing power against hyperscale clients. Other research houses have echoed concerns about rising competition, Dell, HPE, and even in-house options from NVIDIA, eroding profitability. Hedge funds tell a mixed story. Many long-only growth funds were burned by SMCI swings and have scaled back positions amid the uncertainty over governance and the DOJ probe. However, a subset of more value-oriented or contrarian investors has begun nibbling at recent lows. According to one market report, options flow implies the smart money is relatively unhedged. Some see this sell-off as a buying opportunity once legal risks abate. On the insider front, Supermicro has seen consistently more selling than buying. In late 2025, CEO Charles Liang and other executives sold small blocks of stock around the $33 level, primarily for routine tax vesting reasons. And through Q1 2026, no executive has been net buying on the open market. While insider selling alone is not unusual, the lack of high-conviction buying might concern some. Overall, smart money signals are split. Institutional ownership is moderate, 55% afloat, but short interest, lost 18%, and analyst downgrades suggest many professionals are wary. Any sudden shift in these trends, e.g. fresh big buys by mutual funds or new activist campaigns, could quickly change the narrative. Supermicro's fundamentals reflect both explosive growth and mounting stress on the income statement. In Q2 FY 2026, ended DC 2025, SMCI posted $12.7 billion in revenue, up 123% year-over-year and far above consensus. On the balance sheet, cash on hand was $4.1 billion versus about $4.9 billion in debt, bank debt plus convertible notes. That yields roughly 0.8 B of net debt, modest given the torrid revenue run rate. Total assets stood around 14.0 B and equity about 6.3 B, leaving a debt and equity ratio 0.7, well in line with peers. On paper, this suggests a liquid balance sheet. On the flip side, analysts note that SMCI is already profitable, unlike many tech names, and is rapidly moving to positive free cash as margins normalize. The company has guiding assumptions of 699 million diluted shares, so the recent price equates to about $22 forward earnings, since FY 2027 EPS could be 3 past by some estimates. In sum, the balance sheet is not strapped today, healthy liquidity and manageable leverage, but the business is in investment mode. Profit margins are razor-thin and volatile. The only real expense is inflation of working capital. If margins recover and SMCI hits its 40 BI revenue target without blowing out SG&A, then cash flow should swing positive. Until then, the fundamental profile is that of a hyper-growth hardware vendor, huge sales with shrinking profits. Investors rightly debate whether the financial leverage or instability is hiding just below the surface. Growth catalysts. Another big catalyst is expansion into new markets. In late 2025, SMCI launched a federal government subsidiary focused on delivering onshore, made in USA AI servers and storage. This taps into U.S. defense and public sector budgets, which now favor domestically built systems. It also aligns with U.S. export control tailwinds and CHIPS Act incentives. Similarly, SMCI is deepening partnerships in telecom 5G edge, building mini data center racks for telco operators, and in high-performance computing for scientific energy markets, e.g. government HPC projects. More prosaically, any broad industry trend-lifting server spending helps. Cloud providers are still undergoing data center expansion, and many smaller enterprises are installing on-prem AI clusters. Partnerships or endorsements can move the needle too. For example, SMCI recently debuted NVIDIA RTX Pro-powered retail edge AI solutions for an emerging market use case. Such wins, even at modest initial volume, signal the long tail of opportunities beyond hyperscalers. Finally, simply hitting guidance and beginning to modestly re-expand margins could be a positive catalyst. SMCI has guided Q3 revenues above 12.3 B. If they beat again and non-GAAP margins tick up in the next quarter or two, it would vindicate management's aggressive expansion story and likely spark a bullish re-rate. The flip side is that SMCI is not immune to real risks. Chief among them is margin collapse. If gross margins stay in the single digits, as they have this year, SMCI will struggle to fund R&D and meet its own projections. The company has already spent tens of millions on inventory and production ramp-up. Weaker pricing or continuing competition could keep margins low or even push them lower.